Good morning. How are you all doing, students? So, this video is about the key areas, the types of questions which mostly comes for your advanced investment appraisal. In this, we have all our net present value, adjusted present value, your bond valuation, cost of capital. Then we have Black-Scholes option pricing model, real options. So this topic, investment appraisal, is the biggest topic out of all in AFM. So this video is going to be pretty long. As you can see on the right also, so many questions are there that I just couldn't omit anything. I just had to include everything because every question is important. But the good thing is this question is performed good, better compared to others like acquisition and merger reconstruction. Compared to this risk management, and this one is performed better. Students do good in these areas. Why they do good, you will come to know at the end of this video. So keep watching this video till the end to know what are the tips, what are the hacks you have to know to solve a question, because this type of question is pretty long questions. So many questions, calculations are there here, lots of calculations, even the theory parts. But of course my main focus will be on the calculation part, but I have still included some theories for this chapter, because my next video, which will be the last video for this revision, the last revision series, that will be focusing all the theories. So I have tried to put maximum calculations here. So starting on that note, first question you can see is question 11. I didn't write any notes. At the end of this video, I'm going to pick up the important notes and going to write it with you. So you are going to write it as I write. As you can see on the question 11, this question is about Black-Scholes option pricing model. Now, in this topic, this investment appraisal, you have to know the Black-Scholes option pricing model. You have to know what are the 5 variables, how to calculate the value of a call option or a put option. Right? You will be given all the 5 variables. Your thing is just use the formula and put it. That's it. So this is one of the easiest question you can get. But the problem occurs in 2 areas. Your risk-free rate, your time, your standard deviation. These 3 variables is easy. But problem comes in your exercise price sometimes to know whether it's an exercise price or not. And your share price of the underlying asset. So these 2 areas is a little, it's not tough, but these are the areas where students sometimes misinterpret and go wrong. Other than that, there is nothing wrong in this. Everything. So as you can see, this question, they tell you, and they have also already given you the formula. The formula will be given to you in the formula sheet, so you don't have to memorize the formula. But it does not mean that you don't have to practice these calculations. You still have to practice it many times, 10, 20 times, for you to get at that speed. Because come on, in the exam you are under pressure already. You cannot refer the formula sheet all the time and keep doing it. Since this is the easiest, I have included this in the beginning itself, because I want to start from medium, the easy level, then the moderate, then the difficult part. If I start with the difficult part, you'll be like, what is this? So I started with the easy part. Okay, so as you can see here, this is a very old past paper. Now they will not give you all this like this. It does not come like this. They will just give you this only. This much is. So they will only give you this much. That's it. This and this next, this all they will not give you. So this question, first is you have to just use the formula and just write it. Now if you see here, this is how the answer is. Right? Always, whenever you have to use a formula, there are so many places where a formula is required, like in this Black-Scholes option pricing model. You have to write the formula, even if it's in formula sheet, even if you know it. You have to write the formula first, like this one, D1, and even for D2. Then only you have to just see in the next line only they are putting the numbers. So always apply this method. Not only in AFM, even when you're doing your maths, any type of calculations where formulas require this method. Write the formula in full, then you put the numbers in that formula and get the answer. You're not solving it on calculator, right? And if you are doing it in a computer based exam, you will be doing it in Excel. Of course, when you do it in Excel, this will not come as it is. You will only get the final answer because your workings and all will be in your formula cell. So when you click the cell only, you can see the formula. But other than that, when you're writing on a paper, you have to write the full formula. So then you are starting with D1. So this is, you should know how to find the D1, right? You should know it. Once you find D1, always round this to 2 decimal places. 2 decimal places. You have to round up to 2 decimal places. Why? Because when you're using the normal standard distribution table, there the table is only for 2 decimal places. So if you are just, let's assume this one is 0.538. So you cannot find a value for 0.538. You have to round it up to the nearest number, which is 0.54. Even for D2. So both D1 and D2 needs to be rounded up to 2 decimal places. Now coming to D2, they wrote the formula and then they put the number. And make sure that you know how to use a calculator. When you're using a calculator for a computer page, and when you're using it in a computer, in your Excel, make sure that you know. You have practiced it in Excel and you know how to work it and get the answer. If you're not sure whether your Excel is giving you the right answer or not, try to do it in your calculator manually and check your answer with the Excel answer. It should match. Then coming to the next one. So the first step in Black-Scholes option pricing model is find D1, then D2. Okay, I'm writing the steps here. So first it is D1, then it is D2, then the next comes N, D1, then it comes N, D2, then the next is, as you can see here. Another thing you have to remember, okay, when it's ND1, whether it's positive number or negative number, let's say here 0.59, you are getting what? You are getting a negative 0.54, then amount will be same what you get. It will be this only, this is the amount, right? But that time, that amount will be deducted from 0.5. That is the only difference in negative. You have to be careful with this negative or positive. It has to be deducted from 0.5. 0.5 minus that amount. But if it's a positive number, you have to add 0.5 with the probability. So the probability, if you see here, it is always up to 4 decimal places only. So get it. Once you get it, you can find C. If it's call option, find C. If it's put option, another step is required for you to find the put option. Make sure that you know how to identify whether it's a call option or a put option. That's very important. Because if it's a put option, okay, and you are thinking it's a call option and you stop here, you stop there, that 1 mark for calculating that put option, you are missing that 1 mark. Okay, because there's formula for put option also, using that option only. But whether it's a call option or whether it's a put option, you have to know to find the call option. Why? Because in both condition this is required. Let me put a star near C, call option. You have to reach up to that call option, even if you want to get put. If you don't want to get put, even if you want to end it with call option, but you need to find that call option. You have to come up to that state. So the step is same for the put option also. Then now, if you are writing it, you must have put all these numbers in your calculator, and you might have exactly wrote this. But just exactly writing 0.39 is not enough. You will not get the marks if you are not writing this. If you are not writing this. If you are not writing this separately, and if you are not writing like this, you will not get the marks. Each step has to be there. Each number has to be there. You have to show it, not just by calculating, not the final answer. So here it's call option. They stopped with call option. Now, that's part A. All call option, all Black-Scholes option pricing model, this is the way to proceed. All the steps, don't forget. D1, D2, ND1, ND2, call option. If it's put, then put option also. Formula is there, you can go and check the formula for the put option. Now the next is discuss the main limitations of the Black-Scholes option model. Let me highlight this question. The reason why I'm highlighting this question has been repeated many times in different ways. Sometimes they ask assumptions of this model, sometimes they ask limitations, sometimes they write issues. So the words might be different, but they are asking you the same thing only. What is the issue? What is the limitation? What is the problem with this option pricing model? It's for 5 marks. That means what? 5 points you have to write. 5 marks means 5 points. And this 5 limitations, you can memorize it. Because it's not going to change from question to question. It is fixed. That's why I have included this answer here for you. This 5. It is already given in bold, the keyword, so I'm not underlining it. First one, it is only designed for European call options, not for American. And make sure that you know what is European and American. European, you can exercise it only in particular time at the end of the option. American, you can exercise anytime until the expiry of the option. So that is one limitation. But in real life, we know that we don't exercise only on one date. We can exercise anytime, right? Maybe we have an option for 2 years, but we might exercise it before 2 years gets over. Maybe after 1 year we exercise. So that is American option. But this, using this Black-Scholes option pricing model, we cannot value that because this model is only for European call options. So that is number one limitation. You see, when you are watching this video, the advantage I would want to tell you is, added advantages, you are not thinking anything. Thinking is not required. You're just listening to me and you are having a powerful revision of yourself. That's why I am taking time to explain these concepts again. I know I've explained this before in my revision kit. But this is like a full final revision so we are doing a revision together. It feels like I'm also doing a revision with you. So that's why this is a very good revision for you. For all the ones, if you're working, you don't have time, you don't know where to focus on at this few days, last few days, I think day after tomorrow is your exam, today's second, so 5th is your exam. So this is a very good time to utilize this, watching this video. Maybe it will be just around 1.5 or 2 hours, I don't know though. But it will be a powerful one. Rather than you struggling to, try to memorize a whole book. So that's not worth it also. So coming to this, first is done. Second, these are fixed, so you can memorize. Now when you memorize, you're not going to memorize this model is only designed to valuation of European options, basic model. No, you're not memorizing sentences, you are memorizing keyword. What is the keyword? European call option. When this word is there, European call option, you automatically will be able to create sentences on the exam because you have read that sentence. Read the sentence in full, but only memorize the keywords from there. This should be your technique to understand or memorize any theory word, not word by word. Second, basic model is based on assumption that share pay no dividends. So this is the second assumption you can memorize. Third, they assume no transaction cost. Third. Fourth, risk-free rate is known. Standard deviation is known. Is it? So standard deviation means volatility. How can we predict the volatility? They just give you some percentage. 30% is the standard deviation. And risk-free rate 3%. But we know that interest rate, risk-free rate keeps changing. It's not constant. It's variable. But we assume it is constant. The last one is that yes, exactly like risk-free rate, they talk about standard deviation. So this they have taken in 2 separate points. Okay, so these things you should know. Coming to question 12. Question 12 is also very similar. It is, I didn't include the whole case study because question 11 and 12 in your revision kit. If you are following the BPP, as you can see here, that's BPP revision kit. So if you are following that, these questions are very old. It is like full theory based questions only. There are no numerical questions, but such questions you will not expect because questions now are mixture of calculations and theory. It is not full theory. That's why I didn't include the whole case study because numbers are not involved. but I have taken the requirements for you because some of this are even applicable today. That's why I have put this here. For example, part A. With regard to I above, discuss how the company may use idea of options to help with the investment decision in bidding for the exclusion rights and explain the assumptions when using the idea of options in making investment decisions. So this question is not so important for you. Second, with regard to the second, discuss how options could be useful in determining the value of the equity and the default risk. Yes, this is a question which can be asked. This is there in your textbook. How options can determine the value of equity and default risk, and why companies facing severe financial distress will still have positive equity values. So make sure that you know the theory part of this. Even though this type of question has very less chance of coming, but the last one, part C, this type of question has a very high chance of coming. That is, they explain any changes in option values are determined by numerous risk factors, and Vega is one. What is Vega? Vega means, what is Vega? See, there are 5 variables. We know in Black-Scholes option pricing model, 5 variables that can affect the option value or option price. What are those? Standard deviation, risk-free rate, the time, the exercise price, and the share price. Any of these changes, option price will change, option value will change. Vega is standard deviation. How change in standard deviation can change the option values? So that you have to explain for 5 marks. The 5 grades, make sure you know it. It is not so much in depth, will not be asked. Minimum that can be asked is around 5 to 6 marks, that's it. More than that, they will not ask on the 5 Greeks. Right, let me write it down for you. One is delta, one is gamma, and we have Vega, then we have rho, then we have theta. So all these are the 5 Greeks, make sure you know. As the delta means change in other 5 variables. Change in this, 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 and this. All this, it is known as delta. Right? Gamma is the change in delta. Change in D. Vega, as the name suggests, V. This is how you memorize if you have to memorize Vega. Standard deviation, or another word is volatility. Rho. Rho is rate. You can say interest rate or rate. Theta is time. Time to expiry. So V stands for Vega and volatility. The same letter. Rho for rate. Theta, T for time. So this is how you memorize. It's easy for you to memorize. So the Vega comes means volatility. Rho means rate because the letter is same. Theta is time. Only delta and gamma you need to. Gamma is the change in delta and delta is change in all the other 5 variables. That's it, you need to remember. So this is how they have given you the assumptions. If you have seen here, right? The Black-Scholes option pricing model assumptions. Previously in question 11 we saw limitations. So limitations, assumptions, they are same only. It's just a different word. If you see the answers here also, it will be same only. Same, all these are same limitations which are there. Right? So you don't have to go through it again. And part B, I didn't include it. Please go through that theory part. Question 13. Now, question 13 also. So, we know that we have to calculate net present value, right? Investment appraisal means net present value you have to calculate. And mind you one thing, this net present value calculation will definitely come in your exam, will definitely come. There is no past paper without net present value calculation. Either you will have just net present value, either you will have net present value plus adjusted present value, both. But you cannot skip net present value. So that's why it's very important that you know the basics of it, you know all the types of adjustments, calculations you need to know to arrive to net present value. So this question is about that, a very good question to start with. So assessment of new products, obviously they will give you facts about the product, where the product is manufactured. And one thing about net present value, another thing you have to remember is net present value they will always give, I have seen, it is international net present value. Let me write the topic here. They always give you international net present value. That means internationally you are exporting, importing, and you have to find net present value. Of course, that will be in foreign currency, and then you have to convert to your home currency. And exchange rate also plays a role here. Not a big role, but just the exchange rate to convert to local currency, or if you want to convert to foreign currency. So you have to be good with your exchange rate risk also. You have to be good in predicting exchange rate using purchasing power parity or interest rate parity. These two things you need to know in net present value, must. So don't even go to exam hall if you are not prepared well enough for this net present value. This is a same type of question you will see many times. It will be repeated. Coming to the requirements, directly I'm coming to the requirements. Part A, evaluate the financial acceptability of the investment and calculate the investment's duration. This financial acceptability means, in other words, they are telling you to find the net present value. If net present value is positive, it is financially acceptable. If it is negative, it is financially not acceptable. That's what it means. So as soon as you see the term financial acceptability or financial feasibility, you immediately have to understand they are telling you to calculate net present value. Sometimes they will write, sometimes they will not write, mention the net present value, but you should know it's the same. And another addition to this requirement is investment duration. All those things you have to know. Modified duration, Macaulay's duration, bond valuation, if the credit risk keeps changing, the credit spread, the credit ratings change. So all these things has to be known in this. That's why this is a very wide topic. I cannot cover it in 1 hour. It's more than that. Coming to second part. Okay, let me show you the part A, the way it is presented. This is, you will be very familiar with this. You have been doing this multiple times. If it's done in an Excel, it needs to be done properly. You have to put the number of years in Excel. If you're writing also, make sure first when you write your number of years in a column way. If you want to rule it out, please use ruler. You need to be neat, you need to be professional. It cannot be untidy something. It cannot be just a mess. You're cutting numbers there. That's why if you put number, be very careful. You have to be very sure what number you're putting. You just cannot put and then cut and then cut and do all those things. You will not get time there. And once you have finished the table, and if you have identified that somewhere you went wrong, my advice would be that don't try to go and change it. If you try to go and change it, you will run short of time to perform in other questions. Rather, you keep as it is. Based on that, you give your conclusion and all. You will get the marks because you have done your workings and all. But if you have the time, at the end, if you can come back again and change it, then do change it. Cut the whole thing and copy paste on a new sheet. But it should not be like this is a table. Okay, I'm cutting this. Again, I'm writing here 2000. Later I found out, okay, this 2000 is also wrong. Again, I'm cutting. I'm somehow trying to I'm trying to fit somewhere like this. Your table should not look like this. It's very untidy. Your table should not look like that. In short, let's say if you have put that number, what you have to do is cut the whole table like this and put it in a new sheet. You need to cut the whole table and write it. Just do arrow like this. That's it. The examiner will clearly understand, or you can just put like this, cut. The examiner will clearly understand that this is you have cut it, so it will not be marked. But when you are cutting it, wait a minute. Let me erase it. It should not be like this. It should not be like this. And you are trying to put some number here and cutting like this from here. It should not be like this. Because all this counts towards your professional marks. This is professionalism. Okay. So first start with the number of year. If the project is for 4 years, don't forget to include year 0. You always start with year 0 only. Year 0, 1, 2, 3, 4. There are 6 columns. First column is for this, second is for this, third is for this, fourth is for this, fifth is for this, sixth is for this. And make sure when you divide also, of course, this will be equal only. So common sense, right? And of course, the first column will be the bigger one because you have to write sentences. So accordingly, you can do it. Next, we are starting with sales revenue. right? You can start with contribution also. Now there are two places to start. One, you can start with sales revenue, the other one is your contribution. How do you know what to start with? Is if you are given the figures about sales revenue, if you are given the sales price for all the 4 years, if you are given the sales volume for all the 4 years, it is definite that you have to start with sales revenue only. But if the question starts with contribution, they have given you contribution per unit and all those things, then don't struggle to find where is the sales revenue or where are the variable costs. Then you have to start with the contribution and deduct your fixed costs and all the other cost. So here sales revenue they have started, and usually sales revenue, variable cost, all this always have a separate working. They need a separate working. Why? Because sales price changes each year, the volume changes each year. So for that, different, and also inflation. If you're inflating it, so inflation has to be checked whether it is already inflated before or not. If it has not been adjusted for inflation before, you have to inflate it. If it is already adjusted for inflation and inflation figure, just let's say 10% inflation is there, it's given to 10%. But in the case study, you have been told that it is already inflated. Then don't try to go and inflate it again by 10%. Already it is there. So don't do that double adjustment. So here you can see working 1, working 2 variable cost. Deduct sales variable, the remaining is contribution. From here contribution you deduct your marketing expenditure. Now this type of expenditure as you go further down does not have any working, because these are one-off expenditure. Once, maybe once a year, like out of the 4 years, maybe in the first year only this expenditure is there. In those conditions, the working is not required. Working is not required for each and every item. It is mostly sales revenue, yes, variable cost, yes. And sometime and also your tax allowable depreciation. These 3 areas, definite this thing is there. But other than that, other expenditure does not require so much of working. Like marketing expenditure, just 1,500, that's it, deducted. Fixed cost also not working is there, just inflated. Then you deduct your. So I'm just putting a tick mark. We are over with this. Deduct your fixed cost. After you deduct your fixed cost comes tax allowable depreciation. Follow this method the way it is presented. Don't go and deduct your fixed cost from your variable cost. It should not be sales minus fixed cost. If it is sales minus variable cost, you also have to write sales minus variable cost only. Even when you're practicing, keep this in your mind. I have seen students messing it around. I was marking one of the paper of my students, and then I saw this and I told her that you are good, your calculation is perfectly right, you have a very good understanding, but your presentation, that line item is changed, right? Technically, yes, your answer will be correct. Some of you might do like this also. Let me put it here. Sales, and then you deduct your tax allowable depreciation. Now, let me ask you, have you ever seen a paper in a marking scheme that this way, this is presented like this, sales minus tax allowable depreciation? Of course, final answer will be same only. The order does not matter, but in the presentation, you have to keep it like that. Presentation, which is sales minus variable cost, then fixed cost, then other cost, then only tax allowable depreciation comes. So to avoid this, try to follow what the marking scheme has given you. What happens is, when you follow it, you are consistent. What you have learned in one place, you can apply it in all the other places. You will not have that fear that what if I forget. If you are trying to put something of your own in some other way, you try to mess up that arrangement. Then it will be a problem for you to remember which one should I put first, which one I should. So follow their order. You don't need any thinking in that, right? No thinking is required. Just follow them. But yes, let's say there are 6 costs are there. Let's say there are 6 types of cost. Expenses are there. Now there is no requirement to order the 6 type of cost in an order. That you can order in any way, right? The 6 expenses, any order. You can deduct your expenditure, administration expenses first, selling expense, any order. That does not matter. Okay. But yes, tax allowable depreciation, definitely this comes after you deduct all your cost, variable and fixed cost and other cost. Tax allowable depreciation also has working. Tax allowable depreciation, I will circle it. It's a past area, it will come. So you have to be prepared for it. There's no other way. It could be straight line, it could be reducing balance method. If it's straight line, no working is required, just deduct it on cost. But if, because it is same only, taxable depreciation will be same. But if it's reducing balance, working is required. This looks like a reducing balance, that's why working is there. Working 3. Or working will be here for this also. Next, don't forget to put the name as it is. Okay. So don't go and put cash flow after deducting taxable depreciation. You'll be very wrong if you do that. If they have written taxable profit and loss, you also put taxable profit and loss, because cash flow comes after that, right? For cash flow, you have to add back. Don't forget to add back this taxable depreciation. Sometimes, if you have seen some question, I know you are going to ask me this question, that in some question taxable depreciation is not added back. Sometimes it is added back. How do we know? Very simple. In the assumption, they will tell you one assumption is there. There they tell that taxable depreciation or the depreciation amount of depreciation is the same as the amount in additional investment, the amount invested in additional non-current assets, something like this. Some requirement, some assumption in the case study itself, they will give you this assumption that it is same or similar like that. I exactly forgot the exact words, but something it is like that. The depreciation will be same as investment in additional non-current assets, something like this. Then you don't have to add back your tax allowable depreciation. But other than that, if it is not included, then you have to add back your tax allowable depreciation to find the cash flow. Of course, you find tax on taxable profit only. Then you deduct tax allowable depreciation. This is the common method. So I'm only explaining you this method here in this question. When I go through other questions, I'm not going to do it. I'm just going to show you, that's it. So tax allowable depreciation will be same amount only. There's no difference. You are adding just here, that's deduction, here it is positive. Next, your initial investment will be given to you. Your working capital will be given to you in the beginning. But when you see it is in year 0, your initial investment working capital will always be in year 0. And in bracket, and finally your cash flow. So your cash flow will be just initial plus working in year 0. That's why it's in bracket, and other years it will be positive. Sometimes it can be even be negative in the first year or second year also. Right? It is not that compulsory that it always has to be positive only. So, but another area is working capital. Working capital is another area. Increasing that working capital. This it requires working. We'll see how. So that is another area where students can go wrong. I went wrong when I did my paper, so I can relate to you. I understand. Next, after you deduct, then comes your cash flow, right? Next, discount factor. Discount factor also, one thing I have noticed what student is doing nowadays, they are taking calculator on the cash flow, they are discounting it, adding all and finding the present value, but they are not showing this number. They are not showing this number here. It's wrong. You have to show it. This discount factor has to be there. And you have to round up to 3 decimal places. Discount factor. Round up to 3 decimal places. All the discount factor. Of course, for year 0 it will be 1 and then this. Sometimes, even for this, there's a working. Let's say I will keep it as W4. You need to do working to find that cost of capital. WACC. Sometimes it is cost of equity, sometimes it is WACC, cost of capital. If it is all equity financed, like if you have to find adjusted present value, then it is cost of equity, the discount factor. If you have to find just net present value, then it is cost of capital, the WACC. But if they have given you the discount factor, then you can use that discount factor. Otherwise, you have to find out. And then and don't forget to put your present value. Then you have to put net present value. First put discount factor, then net present value. Then present values, then your net present value. So this should be your approach to this type of questions, right? And don't just stop with that. The net present value is this. Write this sentence, or I shall highlight it. What you have to do, because you have to evaluate the financial acceptability. So you have to tell whether it is acceptable or not. Here it is acceptable because it is positive. That's what you have to write. You don't have to exactly memorize the sentence which they wrote. You can write in your own words. Like you can say that the project is positive or the net present value is positive, so the project is financially acceptable or feasible or it should be undertaken like that. Next, we'll show you the workings. Now you can see the workings here. Workings will always be shown after your main table. Workings should not be shown before. It is true that you are calculating your workings first and then going and showing in your table. But when you are presenting your answer, displaying how you are going to start, you write the number of years. Don't forget to put this if you are not dropping down the 3 zeros from the millions. You have to write it. Even in Excel, even in your paper. The dollar currency is very important also. Currency is very important with currency because it is international net present value. But in this case, it's not. Seems like it's a local net present value. They just wanted to keep it easy for you in the beginning, right? But in the real exam, you have to even change it to different currency. That's why that currency is very important there. Now, when you're writing up to that much, then of course you're starting with sales revenue. So sales revenue, just put working one and don't write anything on the main table. Keep some space. Here, if I'm counting number of lines, if I have to count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So it becomes very hectic for me, right? Because I don't know exactly how much lines I have to leave. You cannot be so precise that I have to leave exactly 10 lines and then do my working or 20 lines. No. My advice is leave one whole page. One whole page. Even if you're just using half of it, still leave one whole page. If you cannot predict. If you can predict exactly, then yes, that's good. That's a good. Or at least more than half a page you leave for the main table and then go and start doing your workings. As soon as you finish your sales revenue, go and put in the main table, or you can finish all your workings first and then go and fill that table. That also can be done. So sales revenue, even in sales revenue, even in your working, consistency is important. Because when you're writing here, it is not, when you take it in the main table, if what happens, I will tell you. If you're not writing this here, let's say this is not here. Okay, let me cut it off. And what happens is just 13 to 50. So when I go to the main table, I will just put 13 to 50. It will be wrong. Not 13 to 50, sorry, I will put 1.3 to 50 because already I have dropped down 3 zeros here, if you see here also. So the number becomes very small. So make sure that here also I have dropped down the 3 zeros in the main table. So in working also, 3 zeros has to be dropped. That's why 13 to 50. So that thing you have to keep in mind. Always. In any way, not in sales revenue, in all the other costs also. And then you show your work. And when you show your working, it should be like this all the years. Starting in that order, 1, 2, 3, 4. This is your sales volume. Volume is same in this case for every year. The cost it starts with 100. Okay. So it will be 100, 100, 100, 100, 100. The inflation keeps changing. The price keeps changing at the inflation rate. Here it is 1.045. And then 1.2. Okay. Then it is 1. This is not 1.52. Okay. It is a printing mistake. It is 1.05 to the power 2. Why? Because 1.05 is multiplied twice in the third year when you are taking it. And don't forget to take the previous one. Always the previous is required. On that you are taking 1.3. Here also same way. It is 1.05 to the power 3. On that here again. And then again you have to take. It's not that you are just taking latest only. You have to bring down the previous ones. And on that you have to inflate it. Even for a variable cost if you see. Right? Volumes are same. This is the cost. Here same only. To the power 1, to the power 2, to the power 3. And then this, then this. It is same. And this is in millions. That means if I say it is 5.788 million means, how am I going to write it in the table? You can write as it is. 5788 because you already dropping down the 3 zeros here. Now, so that's are your two workings. Next comes your tax allowable depreciation. It's a reducing balance method. Here also you're maintaining consistency, dropping down the 3 zeros. Then you're starting with the cost. This is your, if you see, this is your initial investment also, 16 million. Then you're deducting, and then on deducting. So first year, second year, third year. Fourth year, it's a balancing allowance, because this has to be a zero at the end. All your tax allowable depreciation has to be equal to your cost of investment, cost of capital, that is 16,000. If you're not sure, just check. 3,200, this plus this plus this plus this, add all and check, it should be equal to 16,000. That's why in the fourth year, in the third year, when you stop at 8192, you're not taking some percentage on this 8192. You're taking the whole amount, because after 4 years it has to be zero. For any tax allowable depreciation, this is the principle. So you better know this, because I know that you have not been told this. That's why sometimes you're confused how this balancing allowance charge, I know it comes. Like, how do I know the amount? This is the way you know the amount. And it is known as balancing allowance. It has to be zero at the end. Always check. After you tax allowable depreciation for 4 years, add all your tax allowable depreciation. It should total your investment. Next, so you're done with the first part of it. They only asked evaluate the financial acceptability, you told. You found net present value. And they also asked another requirement in that. They asked you to find your duration. So duration you should know how to find out. Formula is there. You have to memorize this formula. It's not there. It is the present value. Since you know your present values now, using the before one, 4104. So here if you see, it is... where is it? Yes, here all these values are your present values. You see how you need that table to find the duration? So next, that present value into the number of year. That means this into 1, this into 2, this into 3, this into 4. That's it. This, you add all this now, divide by total present value. Add all. So this should be a duration, 2.78 years. They have given you how you find the present inflow of inflows. If you want to find the present value of inflows, just add your net present value with initial investment. That's it. You will get your inflows, because your inflows minus investment is net present value. So net present value plus investment will be inflows. Same. Now, what is it? If you want to find in terms of percentage also, you can find out. There is another way. This is known as alternative calculation. Only one calculation you have to do. This is for your understanding purpose. Some of you might do this method, first method. Some of you might do the second method. But ultimately, if you see this is also 2.78, this is also 2.78, answer will be same. You might do it as a percentage also, like this. You're finding that present value this much from their total value. What is the total? 24286. Out of this you are finding the percentage, and that percentage you are adding with number of years. This with 3, this with 4, and you are finding and adding all. You will still get 2.78. So make sure that you write this sentence, what it means. It's in bold. Next, so A part is done. Coming to part B, calculate the percentage. If they tell you clearly percentage, means you have to find percentage. Calculate the percentage change in the selling price required for the investment to have a zero net present value, and discuss the significance of your results. This is a different type of question. This question only came for this paper only. So these are some specific questions which come each year. Some questions will come which is specific, will never seen. So this question is also never repeated. But if such a question comes where you have to find the percentage change in selling price, then you should know how to do it. So this question, interpretation is very important. What does it mean? They are telling you to find when net present value is 0, to find the selling price. How much the selling price should fall down before your net present value becomes 0. Now you have a positive net present value. What is your current selling price? I think it's $14 if I'm not mistaken. I didn't include it here. So please make sure that you go through it. I think it's $14 and so of course your selling price has to fall down. That's the only condition. If your selling price falls down only, your net present value will become 0. I'm sorry, it could increase also. I'm sorry, it could increase also, but that change you have to find out. So for this type of question, this is the method, right? In my solution to this question 13, I have shown how you got this, so make sure that you watch that video. Because due to time constraint, I cannot show the whole calculation here, right? And then so they are getting from the total, this is the reduction in selling price, right? And the total is 18%. It fall down to 18%. Now you have to increase the significance. This is the significance. They are telling 18% is such a huge change. So it's right. So you have to tell about it. But make sure that you know such calculation. Coming to part C. For part C, discuss the non-executive director's understanding of net present value and explain the importance of other measures providing data on investment short and long-term performance. So do you believe that only net present value is the only way you can show a performance? Investments short and long-term performance? There are other ways. There are other ways. What are they? You can tell about this. I didn't include here in the answer. So go back and check. Coming to 14. Now 14, a question like this. They might give you different types of process or 2 types of products. So here it is omega and zeta. They have given you after tax clause for both. And here if you see, they have given you capital structure of the company of TISA. They have given you the share, right? They have given you the after tax cost of debt. So capital structure they have given. And also they have mentioned about equity beta, right? Equity beta, asset beta, all those things. Capital structure. Capital structure is given to you means cost of equity, cost of capital, debt and beta. Cost of capital you have to find. So coming to this question, part A. Provide a reasonable estimate of the cost of capital that they should use to calculate net present value of 2 process. Now you see here, to find the net present value, first you have to find the cost of capital for TISA. That is the first question. Second, you have to find IRR. Make sure you know what is IRR. MIRR for process omega. Only for process omega. If they ask for certain specific company, then you only have to find for that specific process. Don't try to find for both. They have already given for process data. The IRR is this much, MIRR is this much. You have to compare after you find IRR and MIRR for omega. And you also have to proceed and you have to explain your recommendation whether they have to proceed with which process. Part C. Okay, standard deviation is this much and average return is this much. You have to find that what is that value at risk. You should know value at risk also at 99% confidence level. It could be 95 or 99%. You should know both level. For 1 year and for 1 year also, for over the 5 years also. Then you have to explain also what that answer means. 4 marks only. Second, apart from the use of VR, explain briefly methods that they could use to deal with risk. So you have to talk about other methods that deals with risk and uncertainty. Make sure that you know what are they. How do you measure risk using which method and how do you measure uncertainty in investment appraisal, and also their drawbacks you have to tell. All these are for 5 marks. So coming to part A, where you have to find cost of capital. Right? You will always be given some proxy company. From there, you have to take their equity beta or asset beta, equity beta, and then find asset beta for your company. And using that asset beta, again find equity beta using your capital structure. It's called regearing, ungear, regearing, and then when you find cost of equity and then cost of capital. So this is the process. I've explained already in question 14, solution to 14. So all this figure how they have obtained, please go and check if you are confused. Right? Sometimes what happens is when you are using a proxy company's equity beta, right? They might have two separate component. You only need for one component because just only one component is important for you. Let's say you are a Pepsi company and the proxy company which you are taking has two, Pepsi and Coca-Cola. Together combined, their equity beta is given to you. But you want to separate out only the Pepsi part because you are in the Pepsi. I'm sorry, what did you say? Pepsi or Coca? Okay, Pepsi. Let's say Pepsi. On the Pepsi, you only want the Pepsi part. Coca-Cola part you don't want. So you have to first separate in their business, the proxy company's business, the equity beta. The two separate equity beta you have to cut out. Take it out. You should know how to do it. And only the one which is relevant to the Pepsi company you have to use it in your company, and using your capital structure you have to find out your equity beta. That's called rehearing. They will give you two components. Sometimes directly you can just use as it is. Maybe because they're in the same line of your business, same product they are selling. In that time there's no confusion. Here there are two. Here's a little bit you have to take it out, okay? Using it. And beta of debt is always assumed to be 0. So this is fixed. You have to find the market value of equity, market value of debt, because without these two things, you cannot find asset beta or equity beta, right? It is already given to you. Maybe it could be bond, it could be loan, anything, debt, something of debt. A debt could be bond also. If they give you market value of bond, that means market value of debt only you have to take as it is. Sometimes they don't give you that it's debt. They just give you debt bond or loans. Then let's say they have given you one bond, one loan. You have to add both their values. Separately you have to find their values, or the value is given to you. Add both the values, that is your market value of debt. And then your share price and number of shares, and then market value of equity. Then using it, equity beta is given to you. You have to find your asset beta. Once you find asset beta, right, what do you have to do? This asset beta is for overall. You want to find asset beta of other activities. You have to exclude it, right? From the overall asset beta, you have to take out that asset beta. So now you only want to find, because your purpose is to find the component asset beta. Once you know, find that component asset beta is this, use it in their capital structure and find the equity beta. So once you get this equity beta using this capital structure, because their equity and assets are different, capital structure is different, then you can use CAPM and find cost of equity. And once you find cost of equity, you should know how to find WACC also. It's important. It's easy. Already you are given the cost of debt has been given to you as 4.5%. So if you have an option, you can round up. It's always round up. Better to round up to whole number. WACC and cost of equity, they always round up. Or you can keep as 12.75% off. Next, that is, you have found your cost of capital. That's it. Part B, they have told you to find IRR and MIRR of omega. Right, if you see here. So to do that, you need all this cash flows. That's what you're doing here. You're taking all the cash flows. Now you have the discount factor. Just now we calculated 13%. You find you're getting a positive. Since you are getting a positive, right, IRR, you know how you calculate. It's like trial and error. But of course in the exam, you cannot keep on finding a rate where you will get a negative present value. Sometimes the next rate which you take might still give you the positive present value also, but still you can find out the IRR using, that is known as interpolation method. Right? Now, next rate, how do you decide the next rate? This is all basics which I'm teaching you again, right? This is positive. Once you find a positive net present value using a discount factor, the next rate should be higher or lower. It should be higher. Definitely it should be higher for you to get a lower net present value or negative. Even if it's not negative, but it should be lower. So that's why they have taken 20%. Now you can take 14% also. You can take 15% also, but it should not be 12%, 11%. It should be higher than 13%. Any rate it could be. You can take 50%, 30% also. And once you do find the net present value same, and here also if you say it's a positive, but it's less but it's still a positive. So don't feel discouraged. Don't try to go and find the third present value using a third discount factor. Right? Calm down. Use this method, interpolation method. This method you have to memorize. It's not given in your formula sheet. So you have to use it. Right? How? The lower rate is 30. Always start with the lower rate, 13% plus. In the lower rate, what the present value you are getting, it will be the denominator divided by the difference between this and this. Since both are positive, so you can minus it. Multiply by the difference between the two rates and 25.6%. Now, next is your MIRR. This method is there in your formula sheet. You can see from there, but you should know which number to put where. For example, you should know what is this, what is this, what is this. You should know all this. So there, just memorizing formula is not enough. Just formulas there, right? I don't have to do anything. I will just see the formula and put numbers will not help you unless you have practiced it and you know what are these values. So when you are writing this, starting MIRR, always write the MIRR formula. After you write the formula, write what each component in the formula stands for. PII is this one, so write it. PVRR is the return, this one. This is your initial investment, 3,800. So 3,800 investment plus your net present value is your present value. Inflow. Now you can put it in the formula like this. Inflow divided by initial investment 1/4 because it's for 4 years. Into 1 plus RE is your cost of equity, that is 13%. Your WACC minus 1. So this is your MIRR. You need to write it. Now, C part asked you at 99% confidence level find VAR. At 99% confidence level memorize this rate. I will put a highlighter. At 99% confidence level, this is the standard deviation. It's fixed. So you don't have to refer the table at 99 and 95%. They will always ask 99 or 95% only. Chance, okay, I have never seen that they ask other than this two. But if they do ask, right, to be on the safe side, if they ask, then you can use the table. Right, so that means 2.33 into the standard deviation they've already given you. You have to find both annual and for 5 years. So if it's annual, just multiply by standard deviation. If it is for 5 years, 5 to the power. Now if you see this is 0.15, what does it mean? 5 to the power half, that means square root of 5. Because it is always square root to the number of years. So it's for 5 years. This is another way of writing it. And make sure that you write what it means, the significance. You have to write what it means. Right? Next one. Other than risk, how to measure risk methods. So for risk, I will put a highlighter again. So for risk, it's expected value. For uncertainty, it is the standard sensitivity analysis. And also payback and discounted payback can be used. Right? So coming to 15. Now, again, like previously, you have been given 2 projects and you have been given some cash flows as you can see. But for Prithvi, you are given all the information, but for Durgi, you have to find out. You are already given the net present value for Durgi. You have to find the IRR, you have to find MIRR, you have to find 19 and 95% confidence level. Here you have to find 90%. So new. Rupat will see what is it. Right? And the nominal cost of capital has been given 10% for both. Right? They have given us the standard deviation as this. They have clearly told they are not exposed to any foreign exchange transactions. Now, let's read the requirements. So part A discuss the aims of free trade areas and even possible benefits to company of operating. See, in this question, the company is operating in the free trade area, such as EU. So what are the advantages? Or what are the aims? This is a theory question, standalone theory question. You should know what is a free trade area, what is EU, what are the benefits of operating within it, what are the aims of it. You should know all this. For your theory part is 5 marks. I'm not explaining it here. Part B, you have to calculate the figure. And you have to recommend also which project out of the 2 they should take. And also another thing is, you have to explain what this measures. In part C, they're talking about legal risk of investing in this project. What are the legal risks? Again, this is a theory question and how this can be mitigated. So I'm not going to cover A and C here, only part B. So if you see part B, IRR. How to find IRR? Cash flow is already given to you. Try at 20%. Why? Why 20%? Because at 10% this is the net present value. See, they have told that is 10% value. They have already given you the net present value is positive. So you use a higher rate to find a negative. That's why they have used 20%. In 20%, you are getting a negative net present value. Now using interpolation method like this previously, how I've used there, you can find IRR. But here it is addition. Why it is addition? Because this is minus. So it will be 2293 minus 1310. That's why when you minus, so this minus becomes positive. Remember, when you minus a minus figure, both will be addition. That's why it's an addition here. But method is same. Coming to MIRR. Same. Everything is same. So I don't need time here. It's just for 5 years, so it's changed. And 14%. Again, the formula you have to use and put the number. Right? But when you're finding the total present value inflow, you have to use 10%, not 20%. 20% is something you tried for your IRR. That you cannot use for MIRR. You have to use an original discount rate, which is 10%. Because at that 10% only, this is the net present value. So you want to find the inflow at that net present value. Sorry, at 10%. Coming to VAT, value at risk, at 95 and 90%. 95, this is, okay, let me highlight it. So you memorize. 95%, this is the standard deviation. At 90%, this is the standard deviation. So 90% is unique, which came here. It does not come. Usually it's 95 and 99%. Coming to next. Now you have to find for what? 5 year. That's for 1 year you found out. So 5 year, just take the square root of 5. Same. Square root of 5, same. Number of years 5. And get it. And just put it here. Put all the figure which you calculated in front of it. That's it. So that now you can compare this and this. The two project. And you write. If you see it thoroughly, you will see that IRR is higher in Privy, but MIRR is higher in Rugi, and also the net present value is higher in Rugi. So that shows that MIRR and net present value are consistent with each other. They are superior also when you are taking IRR compared to IRR in investment decisions. So if I have to select out of this project, I would say it is Rugi. But also other factors matter. If I say Drugi, the chances are, look down, compare the 90%, the risks are more, right? The risk is very high compared to this. So you have to balance out. This is how you balance an answer. That's what it's written here. Just go and read it. Right? So, but since you have to select one, project Durgi should be selected. Right? Now they also have talked about what VR includes. Sub-risk is our project. So they are also saying that when risk is taken into account, it's not an easy choice, because even if return is higher, net present value is higher, MI is higher, but risk is also higher there. So now it depends whether they want to go still carry on taking higher risk or they don't want to. 16 is also net present value. So it's all about net present value, net present value, net present value. This question also has multiple linear equation. Multiple capital rationing. What is it? When your investment is limited for multiple years. First year it is this, second year it is this, third year it is this. Right? And you have been given this. So you have to find this. This is not given to you. And they have also given you all the information. They have given you the sales unit, they have given you the relevant cost, sales price they have given you. They have also told that the cash flow will commence at the end of year 4 and last for 15 years. You should know how to bring those 15 years back to year 0, discount it. But here it's starting with year 4, not year 1, like normally. And also cost of capital is given to you. starting with it. Here if you see, part A, calculate the net present value of the project. So of course it's clear that you have to find out even if they tell or not. It's not there means you have to calculate. And after you calculate, you have to calculate also, you have to comment on the percentage fall in the selling price that we need for this. So the similar question we have seen in 14 also. Coming to second part. Strengths and weaknesses of net present values based on making investment in capital rationing situation. This is the theory part. 5 marks. Next. Formulate an appropriate capital rationing model based on above investment limits that maximize the net present value for department 2. Find a solution for the model. See, finding a solution for the model is not required. It's never required. So don't worry, you will never be asked to solve that linear equation. But you have to set up the equation. Capital rationing model means the linear regression. Multiple linear regression. Right? And part C, they have given you also category 1. These are category 2 and this is category 3. So now you are required to do what? Part D. Okay, there's another requirement. Explain to the company why they may want to impose capital rationing. I will highlight this. It's a key area you need to work on. And also this is another question which is repeated. So it's highlighted. The features of capital investment monitoring system and discuss the benefits of maintaining. So what are the benefits of maintaining such a system and the features of capital investment monitoring system? 4 marks. So this answer, this and this you can memorize the answer. Right? Understand and memorize. Just don't memorize. I don't promote that culture of memorizing. But if you want to, you can. Because it is fixed. These theories are fixed. So coming to part D, you have to find the net present value, right? How do you find net present value? Here you cannot provide that table, first year, second year, third year. Even though they tell it's from 4 year to 15 year, does not mean that you will create 15 different columns. Come on, it does not make sense, it's not reasonable. How will you fit 15 columns in a page, right? So you start with sales revenue, sale price into quantity, annual cost is given. So sales minus cost is your cash flow. Then 15 year in annuity, starting from year 4. Initial cost is this in year 0. In year 1 it is this. This is the discount factor. This second year, and third year, and then this will be outflow. Right? And then this. Then you are getting a net present value. This 0.94 is from the 4th year, from this year onwards. Right? And this is the annuity factor for 15 year. Starting from year 4. And then you have to discount it back to year 0 using the 4th year's discount factor. Just want to go. So how do you find the cost? This 2.5, 1.2 and 1.4. These are the cost. Investment required. That's why if you put here also, you're putting it 2.5, 1.081 and 1.137. Right? 1.2 and 1.4. You need to discount it. Now sensitivity analysis. Another word is known as sensitivity analysis to find the reduction or increase in selling price so the net present value falls to 0. That is known as sensitivity analysis only. You have to know sensitivity analysis. Right? So how do you do sensitivity analysis? To find. It is simple. Your outflow should equal to your inflow. So your outflow, just equal your outflow from this year, 2.5, 1.081 and this. These 3 are your outflows. Just add all these 3, this is your outflow. But your inflow, if you see, it is something like this. It's greater. So this would mean annual cash flow will need to fall. First you have to see how much your cash flow should fall down. Right? So this 4.781. You divide it by what? Right? In other words, okay. So this you can, okay, I will show you here. So what is it? Okay, 4718 equal to 5099. But if you see this 5099, I will break down this further. It's not 50, it is this last table which is giving a 5099. That means it is 0.97 multiplied by 7.191 multiplied by 0.731. See, this one and this one are fixed because this is annuity factor, this is discount factor. This is only your cash flow, only this will change. So that's why you are taking this, you are dividing it by 4.71, you are bringing this and this on the other side and dividing it. So this should be your cash flow. You see it is currently 0.97, this one, but it should be 0.897. So how much it should fall? That fall you need to know. So sales revenue would need to fall by this. This is your cost you are adding. What cost? This cost, annual cost. Because you just got your cash flow as 0.897. So you're adding back your cost to get this sales revenue. And from this sales revenue, you will divide 300,000 to find this sales price you want to find out. That's why you divide this by 300,000, find the sales price. Before it was 14 if you see here. 14, right? So it will fall down to 13.76. How much it fell? The difference divided by before one and this. Not a good one. Because 1.7% change is very highly likely that it can take place. Percentage is small is risky. So that's what you're writing in the conclusion. Very sensitive to changes. That means if a selling price changes by a very small amount also, your net present value will fall below zero. That's what it means. You should know how to interpret sensitivity analysis. Coming to second part, where you need to talk about other methods, then other things, how net present value can be used in capital rationing model. So all this are theory part, you can just go through it, right? For example, net present value, it knows the flexibility, right? It is not suitable for one-off projects, because in one-off projects you might not have flows of cash inflow like this. Next, coming to part B. Part B, it is fixed multiple capital rationing model. You should know how to use setup. So there are 5 projects. That means 5 variables will be there. X1 project 1, X2 project 2, X3 project 3, X4 project 4, X5 project 5. First you have to put variables. Now those letters can be anything. It could be Y also. A to Z, any letter. 1, 2, 3, 4, 5. Okay, because 5. So X1. So now what is the objective? Your objective should always be to maximize profit. They have told you. The objective they will give you. Maximize net present value. So that's why add your net present value of all the 5 projects with it. This is for X1, X2, X3, X4, X5. Add. If you see here also for project 1. Where is it? This is the net present value. This, and this you have just found out. Whatever you have found out, that you have to take for 5. And multiply and add. So that is your objective. Now the constraint. First year it is 4,000. I'm sorry. First year it should be greater or less than. You see this? It should always be greater or less than. This is how you have to set up. First year 9,000, 6,000, 35,000. And this should be equation for X1. How do you get for constant year 1? Let's say if you have to go year 1, I will take you up. So you start like this. 1, 2, 3, 4, 5. So 4,000 into X1, 800 into X2, 3,800 X3, 3,900 X4, 2,500 X5. Less or equal to first year, which is first year this one. 9,000. Because it's for year 1. All the 5 projects like that you have to take. Even for year 2, even for year 3. Which I'm not repeating it. So like this, you need to set for year 1, year 2, year 3. Next, where all this will be greater or equal to 0. Of course, it will never be less or equal to 0. Then you have to explain what it means. What category 1 means, what category 2 means, what category 3 means, and see. Category 1, they have given you something. They themselves have presented this is the total final value. That means I'm assuming under the constant that will be the total net present value. Right? That's what they have wrote here. Coming to category 2, what does category 2 means? Category 2, they have given all this figure. I'm sorry, it is repeated. Okay, just forget about this. Just copy paste again the same thing. So 0, 1 means project 1 cannot be done fully. It is only done 95.8%. Then this. This is, you are not at all taking project 4. Project 5 you are taking fully. That's what it means if you explain here. Right? So make sure that you know. And example 3, all the slates are 0. That means it is fully utilized. So coming to 17. Here also you have been given the cash flows for a project of the 4 years. Sometimes you will be given a real option also. So you have to be prepared for that as well. In a net present value, a real option is there. Even real option also, how do you value real option? Using Black-Scholes option pricing model also. There also you have to know whether it's option, call option or put option. Because real option, there are 2 types, right? 2 of the real options are called, 2 of the real options are put. Option to expand, option to delay, option to abandon, option to redeploy or switch. 4 real options are there. Make sure you know all, and under a condition, specific this thing you should know what it is. Let's say you have been given an option to expand, but you might think it's an option to abandon. So your calculation will be wrong, because option to abandon is put option, option to expand is a call option. So that's why you have to be very clear what option it is. Sometimes it's clear from the case study, the words they will use, expand, delay, sometimes it's not clear. But you have been given standard deviation, risk-free rate, all those things is given. That means you have to use Black-Scholes option pricing model. Coming to the requirements. Estimate the financial impact of the trader's decision to delay the production. Definitely it's option to delay. So you have to show what is the financial impact of delaying the product. Okay, you have to use this. Here they have told, but they might not tell you, but you should know what method to use. And then implications of the answer in part A, 7 marks. Third is, discuss how a decrease in value of each of the determinant. Decrease in value of each of the determinants means 5 variables are there. If all the 5 variables reduce in value, what happens to the option price? For the European option, I have to change the price of a call if it's a call option. Of course, option to delay is a call option. So coming to part A. First, you have to find the value of an option. How do you find out? For that, you need to find the net present value first. First, you need to find the net present value, then only you have to find the value of an option. The two has to be separately calculated. You just cannot, without finding the net present value, or if they have not given you the net present value, it is not benefit. It's it's not of any use if you just find the option value and give it, right? That's why first you start with net present value, because here they have not given you net present value. They have given you the cash flows, but and cost of capital, so you can find the net present value. That is the first thing you have to find out. That's what they have done here, right? Here if you see the cash flow, you are seeing it's 25, 18, 10, 5. But here if you see 25, 18, 10, 5, but it's in the 3rd, 4th, 5th and 6th year. But first 0, 1, 2, it is 7, 7, 7. So sometimes just don't copy paste the cash flow as it is. Some information you have to read and understand from other. Here they have told they will spend 7 million next 2 years. That means 0 and 1, it is 7. And then after this, following this, the company will require 37 for production at the start of the 4-year sales. That means after that the 4-year sales starts, which is this, and this. So that's why it is 7, 7 and 35. Next discount factor is 11%. They have given you the discount factor. Find the discount. If you find net present value is negative, is it worth investing it? No. And that's why you have to find the option value, whether it will add value, whether it will make the negative net present value to positive net present value, right? So now you have to write it. Don't stop there. Without the option to delay, the option should be rejected. So find the option value. Option to delay. Call option. Write the formula. Again write the formula of D1. First write the formula of C, then D1, then D2. Then what is PA? PA. You can write variables like this, what it means. TRS, D1 and D2. P is the exercise price, that is 35. PA, present value of cash inflows, that's what it means, current value of project. How do you find the current value of project? from here. This 4. You should know how to find PA. If you see, you can understand whether your PA and P is correct or not. It will always be somewhere very close to each other. It should not be like PA is 100 and P is 35. That means you are wrong somewhere. It should be very close. PA and P is always very close. Maybe P is higher or PA is higher. Does not matter, but it will be close. Like 35 and 38 points are very close. The difference is very minute, just 2.5. So, exercise price, time, 2 years. They have told 2 years. Risk-free rate have been given to you. Standard deviation has been given to you. What else? Use it, put it, find D1, 2 decimal place, D2, 2 decimal place. Both are positive. From the table, get the figure, add 0.5 with it, find ND1 and 2. Again, use this figure in the formula and find this one. Once you find out what is the total value of the project, you are getting a negative net present value here, 2.98. This needs to be deducted from here, from your total to find. So this is the total value it has. So therefore, the project is now accepted with the option to delay. Implication of the results you have to tell. Coming to part C, value of the option depends on the 5 variables. All the 5 variables we are giving here. Price of security, exercise price, risk-free rate, time, and standard deviation. What happens when each reduces in a call option? Okay. So quickly I will just go through the answer. When the price of the security reduces, for call option becomes, let me highlight it, less valuable. Now why is it less valuable? It's a call option, option to buy. Option to buy means you want to buy at a lower price. So if your price of the security falls down, that means your exercise price is more expensive, right? Now, so you will not exercise the call option. That's why call option has no value. Value will reduce. Coming to exercise price. Exercise price, if it reduces in value, you will definitely exercise it because it's a call option, option to buy. You anyway want to buy at a lower price only. So if exercise price reduces, that means more valuable. You see, price of security, exercise price, they move in opposite direction. Risk-free rate, less valuable. For call option, option to buy, when risk-free rate reduces, it becomes less valuable. It goes in the same direction. Value of risk-free rate falls down, call value will fall down. Time to expiry, again less valuable. You have a lower time to expiry, your value of call option will fall. Because more the time you have towards expiry, value will increase. So time, greater the time. Why? Because the time, there's a value for time also. That is known as time premium. Next, standard deviation, less valuable. Standard deviation if it's less, right? Or call option becomes less valuable. Because volatility, the security price means what? It is more secure now. The security price will not change so much. The share price will not change so much. Standard deviation is less. That means it is option. You will not exercise option. When do you exercise option? When it is very uncertain. When volatility is high in the market. When you are not sure what happens to the share price. That time you exercise option. But if it is already stable, why will you exercise option paying high premium? That's why option value reduces, call option. So if you want to memorize this whole thing, volatility V, time, risk-free rate R, and your price of security. All these things value will fall with the call option when C falls. Only when your exercise price increases, when exercise price falls down, call option will increase. Only your exercise price is different to call option. Rest all is moves in a similar direction. If it all falls, value of call option will fall. Simply, this is the way to memorize. Coming to 18. So 18 you can see, 18 is a little unique. We have hedge ratios and all those things. As you can see, you have been given 350 cents per share and a contract size. This is a contract size over the counter option, right? And you have been given the share price also, 40%, bank rate 4%, time is also there. Now, estimate the number of OTC options. This question can also be asked. It's not very common question. Very rarely it has been asked. So number of OTC put option contracts. Put option that they will need to hedge against adverse movements. Okay. You may assume that the delta of a put option is equivalent to ND1 and you have to give a brief explanation. Discuss the possible reasons for the suggestions made each of the three managers. So I didn't include it here, but there have been three managers who have made some suggestions. So you have to discuss the reasons for those suggestions, why they came up with such kind of suggestions, which I'm not going to discuss in this video. It's not important. So now coming to part A, I have already included part B. Part B I have not included. Go and read the answers. Part A. So first D1, definitely. So my focus here is only on D1. I don't want to find D2. I don't want to find call option, everything. Write the formula. Always, if you see the marking scheme, they always start with the formula. D1. Now, D1 is exercise price. See, exercise price is 340 share price, 350, and 340 is the PA. So PA is 340, exercise price is 350. Risk and then standard 0.5 standard deviation time is 2/12, 2 months, and then since D1 is negative, they have told you one thing as a note. When they give you something, always read the note. Very important. You may assume that the delta of a put option is N minus D1. So if it is N D1, so minus D1 will be this. It will be positive. Just change the number sign. If D1 is minus 0.06, minus D1 will be 0.06. So since it's positive, now you can add with 0.5 because it is positive now. Normal way. This will be from your table. So you get this. Once you get this, this is the way. This is a fixed method if you want to find number of put options. What is it? You have been given the number of shares, divide by this figure here, multiplied by 1000 shares. So this is the number of contracts. If you want to find the number of contracts, this is the fixed method you have to memorize. Why 200,000? I have not put here the whole case study. So, and finally, the suggestions. Coming to 19. Now if you see, so many questions are on this Black-Scholes option pricing module. So that shows you the importance of it. That how well you have to be prepared for real options and Black-Scholes option pricing model. Coming to 19. So 19, if you see, initially, right? Initially, their negative net present value is this much. Right? Now you have to find, again you have to find, I can see cost of capital, risk-free rate, standard deviation. Definitely I have to use Black-Scholes option pricing model, this tells me. And 15 million additional expenditure, that means what? This is an exercise price. And in 3 years time, so time also they have given you. Now, A. Assess showing all relevant calculations whether they should proceed with the opportunity. So discuss the assumptions made, other factors which will affect the decision whether to establish a plan. Black-Scholes option pricing might be used. They have mentioned about it. B. Options review, what it means. Rho means what? Rate of interest. I have told you R. And discuss the impact of changes in interest rate. So if interest rate changes, what is the impact on the appraisal of the investment? And C. C is a question, theory question. I'm not going to cover it here, right? It's about World Bank and International Development Association, all those things. So coming to part A, now you are using the Black-Scholes option pricing model, right? Volatility is straight, exercise price is 15, exercise date, risk-free rate. All these are there. Current price you have to work out. It's not easy to find out. So it is 15 million into, this is the discount factor. The exercise price is 15 into this. Because it's for 3 years, I suppose. Yeah, in 3 years time, this is the value. So in year 0, what will be the value? That's why you're discounting it to find the current value, current price, which is this. Now you know, put it in the table, find D1, find D2, ND1, ND2. So both ND1 and ND2 are positive. So you can, I'm sorry, this is negative, but you have to round up to 2 decimal places, like here, because it is 4 decimal places. You cannot use 4 decimal places. That's why you're deducting from 0.5 and use it and then find this. Overall value, initial net present value was negative. So deduct it from here and find the overall value is positive. Right? So investment has positive net present value, so should be accepted on these grounds. That's it for 19. Coming to 20. 20 is something to do with bond valuation and all. Yes, something new finally after a long time of option. So a bond will be given to you like this. 3 bond redeemable with the coupon rate, market value. Ratings will be given. You should know how to apply the rating when it changes and all. Now, what are the requirements? Let's see. So there are 3 requirements, A, B and C. A is asking you have to calculate the valuation and yield to maturity. Make sure you know valuation is different, yield to maturity is different. Yield to maturity you have to use IRR of $100 bond under each old and new credit ratings. Credit rating changed. This is a common question. Part B. Discuss the factors and mind you one thing, this bond valuation can come anywhere. It can come in your reconstruction. It can come as part of your acquisition and merger. It can come as a part of your investment appraisal. So bond valuation can be put in any way. That's why you have to be prepared in totality for bond valuation and the yield to maturity and all those things. It can even be used in your exchange rate risk management. Interest rate risk management. So discuss the factors which may affect the credit rating. This is a common question. Can I put highlighting? The factors which the credit agencies use to give you a rating. It's a common. Memorize it. Points are there. 8 marks. So you can give 4 points. 2 marks each. Part C. Discuss the impact of the fall in the credit rating on his ability to raise financial capital. Another key area. If their credit rating falls, what is the ability on the financial capital? Impact on it. So coming to part A. You should know how to find the yield rate. How do you find it? How do you do it? So you start with the current value. Coupon is 9% for the first year 1 only, right? So when you write it, it will be 101 4 equal to, because this is the value. This is your coupon. 1 plus, this you need to discount it. That's why 1 plus r to the power 1. So common yield curve means basically that rate you are finding out. Usually you are given the rate. So coupon divided by your rate and you find the market value. Here you have been given the value, market value. You have been given the coupon rate also. What you have to find is the interest rate. That's what it means. So you're going backwards. Right? So like this and then this is the rate. But that is only for the first year. When you're coming to the bond 2, first year you can use 4.81%, but for second year you have to find the rate. So second year, if you see here, it is 102, but this time 107 coupon. 7% means 107 because they told it's for 100. Face value is always 100. You have to take 7% on 100. Yes, $100 bond. Sorry. So with this 100, you add with the coupon, the interest. That's why you're taking 107 or 109. Okay. So 102, this is the market value, then this 7 for the second year. Here you directly took 104 because only 1 year. In that 1 year you are paying the coupon also, you are paying the 109, you are paying the coupon also, you are paying that 100 also. Principal value is 100. Second year means in bond 2 there are 2 years, right? First year you are paying just the coupon. That's why it is just 7. Second year you are paying 7 plus 100, coupon plus principal. That's why it's 107. But first year, if you see the rate, it is 4.81%. Exactly this first year's rate. You can take it. But second year you have to find out R2 to the power 2. So make sure you know how to make R2 the subject and find this is the R2. Third year when you're coming, still it is repeated again. Here for 3 years, 6%. 98 is the value, it fell down. Definitely ratings went down. So 98 is the market value equal to 6% first year, second year also again 6, but third it will be 106. But here you can use the first year's rating, the bond 1's rating, second year's rating, bond 2, third year you have to find out, and this is the value. Now using it, just put it here, year 1, year 2, year 3. What is your old rating? Old rating is this. When it was basis point means 0.1 is 0.31, 0.41. Just add with it, and these are your values. But under new, your new it will be double B, double or triple B, triple B. This will be your values. Now you add this with your Gamma yield curve, and this will be your new ratings. So if you see your new, compare this with this, it increased, this increased, this increased, everything increased. So what you did, right? You still not to answer, you still didn't reach towards the answer. Remember it, you have to find the valuation of the bond. That's why you found all those ratings till now, for you to find the valuation of the bond using this rate, using old and new. So first year 810, because 2% premium they will pay, that's why it's not 108, it's 108 plus 2, 110. It is 8. Why? So they told somewhere, yeah, 8%. So 2. I didn't include the full case study, that's why I'm not able to find out. Now you can use this rate. If you see, it's from here already, old discount factor, but you have to put to the power 1, 2, 3, and this are your discounted cash flow added, and this will be your bond valuation. Under old, under new, this will be your factor here. First year, second year, third year, same amount, 810. Now you see your bond valuation, it fell down from here to here. Now you have to find yield to maturity. Yield to maturity, you have to use IRR formula already. This is how you show your yield to maturity. Fixed method, right? So first you have to find your bond valuation. Definitely, you cannot find your yield to maturity before you find your bond valuation. Valuation of bond is required first, based on that only. So coming to your old credit ratings, let's go up. What is your bond valuation? We are starting from here. Let me highlight. We are starting from 103.8 like this here, if you see. Then you are starting from 1 to 3. What are you paying? 8 and 8. Even in third year, this has 8. This has 8 in it. Plus 100 and plus 2% premium. But 8 is there in the third year. That's why from 1 to 3 it is 8. Third year it just has 102 because 110 minus 8 is already there in 3. You have included here. So here you are showing 102. Discount factor is 8%. Right? This is annuity factor if you show here 1 to 3. Take it, find it. It's negative. Definitely it has to be less than 8% for you to find a positive net present value. So you're using 7%. It can be anything. Using it, you are getting a positive. Now use IRR and find yield to maturity, which is 7.16%. Now using new credit rating, methods are same. It will be 8%, 7%. Only the thing is this is changed. That's it. This is changed. It is the new bond valuation. This 102.7. That's it. Rest all is same. Yield to maturity you use and find out. This next. So you can see that your market value of bond has fallen by 1 and yield to maturity. So market value falls down, yield to maturity increases. This is your relationship when your credit ratings fall down. If you see, market valuation before was 103.8, now it's 102.17. The difference is 1.1. But yield to maturity before it was 7.16, now it is 7.58. It increased to 0.42%. Coming to part B, these are fixed. There are so many, but two common. How they give credit rating based on country, the country you are at, and your industry, your financial position, your stability of your earnings, all those things, blah blah. There is such a big list. Coming to 21. So 21, you have been given a balance sheet like this, right? And if you can see here, this redeemable bond is given inside your non-current liabilities, and you have been given to free cash flow to equity like this, right? Now you have been told that after taxation, interest in reinvestment in assets, right? So this is what I have been telling you. This assumption is there. Good that I came through this question. It can be assumed that the annual reinvestment in assets required to continue with the current level of business is equivalent to the annual amount of depreciation. Now you don't have to deduct your taxable depreciation. You don't have to add back your taxable depreciation when you have to find cash flow because of this assumption. Whenever this assumption is there, right? So now you have been given the ratings also. If you can see the ratings and how the value reduced. So other information will be given to you. All about risk-free premium, beta, equity beta, asset beta. 60% is for hotel service, 40% is for the property business. They will give you the percentage like that to separate out. Because when they give you equity beta, it is for the whole business, combined business. So you have to separate out for property and hotel service. So calculation of equity beta, all those things. So calculate and comment on company's cost of equity back before and after implementing the proposal. Assumptions also you have to explain. P, validity of assumption. So what is the validity of assumption? The market value of equity will remain unchanged. So here they have told that market value of equity will remain unchanged even after the implementation. Right? It's highly unlikely that it's going to be valid because it usually changes. So that you have to discuss. 5 marks. But we are not going to do it here. Only part A I am focusing. So before you implement the proposal, simply just use it. CAP and find cost of equity and cost of debt. Easy to find out. Now next you have to find market value of debt and equity. Why? This is required for you to find the cost of equity and WACC after implementing the proposal. So market value of debt from the balance sheet, from income statement, balance sheet. It's 5.2% and 42 million. That's why it's 5.2, 105.2 because it's 3 years, right? And this you will get from this ratings, this 4.9% to the power 2 to the power 3 and get the value. Once you get the value, take 42 million into this price. So this is the price you're finding for 42 million. Just now we saw in the balance sheet the value is 42 million. So this is the total value of debt. Now you have to find the market value of equity, right? They have told that for market value of equity, it is stated that they can use free cash flow to equity. So to find that free cash flow to equity, you have to use this. What is this? Growth model. This is the rule. This is the retention. Let's say sometimes they clearly don't say how much you are retaining. They just say 60% are distributing as dividends. That means what? The remainder you are retaining. So 60% you are giving as dividend means you are retaining 40%. You only need the retention rate 40% to put in this formula. Sometimes clearly they tell you that this is the percentage they are retaining. Okay. Cost of equity 10.6% here. This you need to use here. Cost of equity, right? Not cost of capital. So you multiply and this is the growth. Once you get the growth, why you need to find the growth? To find free cash flow to equity. So this is the formula. Free cash flow to equity. This is the free cash flow to equity. This is the growth. Cost of equity, growth. This is rounded. Now how do you find the proportion of equity and debt? They have not given you out. But if you see equity and debt, sometimes this is required. This is called your presence intelligence. This is 42,344. This is 42,614. If you see, very close they are. Almost they are very similar. They are not identical, but they are very almost close. Equity and your debt, market value of equity and debt. So the proportion what they have given is close to 50-50. So you can use it. This is your presence of intelligence. So use as 50-50 and find back. This is what before. Now after implementing, you can use what? Asset beta for the proxy company and find the asset beta of your company. Once you find out. Asset beta you find out because you have been given the equity beta. Now that asset beta is for both. 0.61 includes both. You have to separate out to hotel services. Right? So this is the asset beta for the hotel services. Once you find, you cannot use asset beta of a company. You have to find equity value only. So we need equity beta for hotel services only. This is the market value of equity. They told it will not change. They told not it will change. This is the market value of debt. Ratings will change. That's why this also changed. So again you have to find market value of debt using this rate. but this will be same 5.2 and 105.2, and this is the value. Once this is the value, if you see this reduced, before it was 42 million because you are paying off your debt. I think around 30%, or I don't remember the percentage, but by some percentage you are paying the debt after proposal. That's why that debt reduced. Then using that price, this is the value rounded. Now using your equity value, market value of debt and equity, you can find the equity value. So this is the equity beta. Old day of hotel services. Because you only need hotel services. Use that equity beta and CAPM, find cost of equity. Then you find WACC, which is 8.2%. Now put all before proposal, after proposal, compare what happened. You need to say cost of equity increased because, cost of capital increased because, equity beta was higher because, is it better decrease, WACC increase. You have to say the reason why. And the reasons are pretty much all the time it's common. Asset beta increases when it is, see, asset beta is about financial risk. Sorry, asset beta is about business risk. Equity beta involves financial risk also. Let's say if you are taking more debt, more loan, your equity beta will increase. If it's about business risk, your asset beta will increase. And your WACC, whether it increases or decreases, also depends on your debt. If your debt increases, if your tax, which you have to, it's a tax deductible expense, right? Interest. So if that benefit is more than the increase in equity beta, then your WACC will reduce, otherwise it will not. So coming to question 22. So if you see how many questions till now I have covered, 11, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So 11 questions I have covered. I will try to cover 22 and 23 because then my 25 series questions will get over, and for the 50 mark series question, that will be part 2 of this, that I will cover in part 2, where I will be explaining the report writing, in a report writing how you have to calculate, do such questions. Because if you see net present value, usually comes in your section in 50 marks question where you have to write a report. So there also you need to work out how you do it. So let's try to finish question 22 and 23 and end it. So question 22, you have to calculate the Macaulay duration of the two bond, and you have to discuss. I will mark this as key questions. Useful duration as a measure of sensitivity for bond price to change in interest rates. Yes, duration measures how sensitivity the bond prices are to the change in interest rate. A diagram is there, and then these are some criteria. Previously, right, some criteria is there, right, which credit agencies use to give credit ratings to a company. What are they? Industry risk, earnings protection, financial flexibility, evaluation of company's management. You have to explain each criteria and suggest factors that could use to assess it. We're not going to do that. We are only working on part A and B here. But this is a very short case study. So starting with part A. The market price of the first bond is this. It has already been given to you, I guess. Yes, it has been given to you. The market price of the first bond is this. So don't waste your time finding the market price of the first bond. You have to find second bond. Right? So clearly if you see this question, they have, how do they start? They tell you that to calculate the duration of the bond, they didn't directly jump to calculate the duration. If you see, they need some figure before that. What are they? Present value of cash flow, selling price of bond needs to be calculated first. To obtain the present value of cash flow, they need to be discounted by cross redemption yield. This requires an IRR style calculation. So first, this table has to be there. When bond valuation you have to find out, or whether IRR is for 5 years. So 1 to 4 interest, second year with redemption with capital. That's why this is 60, this is 1000 plus 60. How am I seeing it? Coupon is 6%. Par 1000. Usually par is what? 100. But here it is 1000. That's why it is 60, not 6. Okay. And it is redeemed at par in 5 years time. Now if you see, okay, so the discount factor is 5%. You find the present value. Once you find this present value, you use the discount factor 4%. It has to be lower. So then this is the value. Now use IRR and find it is this gross redemption yield 4.2%. That is the bond 1. So bond 1 will be 60, 60, 60, 60,000, 60. 4.2%. This discount factor you were finding using IRR. That's why you did this table first. To find the value, the two present values. Once you find the present value, use that IRR, the discount factor here, and discount all the interest and the interest plus redemption and find. So this is bond 1. Now when you are coming it, you want to find the duration. Duration means multiply the present value by the number of years. So here use all this and put here. These are the present value. Multiply by number of year 1, 2, 3, 4, 5. Add all. This is the total duration from this total, right? Divided by this, because this is the total present value. 4.459 years. Or this is for bond 1. For bond 2, the method is same, the number will be different. So it is same 40, 40, 40, 40, 40. Now why 40? Because they told here, if you read here, bond 2 is 4% coupon rate for second bond. This is also redeemable in 5 years time. Both bonds are expected to have same gross redemption yield. That means for the second bond, you don't have to find gross redemption yield again. You just have to find the value. So 40, 40, 40, use this rate, same rate, because they told gross redemption yield is same. Find the present value. Once you find the present value, just multiply by the number of year and find same way. If you see 4.63, this is 4.49. This is more, bond 2 is more. So P you have to explain. This answer is fixed. You can memorize the whole answer, read it. Whenever this question is there repeated, copy paste this answer. This thing if you see here, I'm just taking you through. It assumes that it's a linear equation, but it's not. It's a convex relation. They have even included this diagram, is there in your textbook also. So make sure that you go through this, and here they're talking with all industry uses, earnings protection, financial flexibility, valuation of company management. You can read these points. I will not say memorize, it's too much to memorize, but you can just read these points. This will help you. So in short, if I have to explain this graph to you, it means that if your interest rate increases is big, then this is not a good method. Duration is not a good method. If it's small interest rate changes, then it's good, because it assumes a linear relationship. Now coming to the last question in this video, okay, 23, because after this we are starting with 50 marks section question, which will be pretty long, which requires more time, so that there'll be part 2. If you see here, some cost you don't have to take. You have to understand which cost to involve, which cost to take. Like this is a feasibility cost this much. Ignore this cost. Don't put it anywhere in your calculation. This is a sunk cost. Research cost, all feasibility study cost. This is sunk cost. Exclude it. Then you have been given table. You have been given the sale price, how much it will increase, what is the sale price, what is the growth. You have been given the initial cost, manufacture, right? You have been given the overhead cost, how much it will increase, the working capital requirement, everything is given in all this. Then you have been given the tax rate, discount factor. So this question involves both adjusted present value and net present value. Evaluated financial grounds, whether they should proceed with the project. It includes net present value for sure, we know. It includes adjusted present value also. If you read this part, you will understand it better, because they will give you subsidized loan, they will give you issue cost. So all these terms means adjusted present value is required. Part B, discuss the appropriateness of evaluation method used in explaining assumptions made in part A. So assumptions made in adjusted present value, assumptions made in net present value. How did you evaluate based on those two methods? You have to discuss it here. How appropriate it is to use those methods. That we are not going to cover here, but part A, yes, definitely. So here also if you see, I'm not going to do anything. Starting with sales, working is there, direct cost, working is there, specific fixed cost. Fixed cost can be specific also. For that also working is there. Then we have taxable cash flow. starting with 1, they have a dollar millions, then tax 25%, then capital allowances they deduct. Sorry, they add back. Add capital expenditure, sale of the project, they might have sold the project which is included in 4th year, working capital is same. You should know when working capital is there, it starts from year 0, but here you are recovering everything. So basically it's just the addition of 0, 1, 2, 3. The addition of that will be recovered in year 4. Then net cash flow, then discount factor also working is here, separate working, I told you. And then you're finding this, which is positive but marginal, right? Base case net present value. Because this is adjusted present value is required, so this discount factor includes cost of equity, not WACC. Now separate working is there for sales. If the sales unit and prices are different, put like this: volume in one line, sale price in one line, and then sales revenue. Coming to the cost. Now there are many types of cost here. Every cost is based on units, so sales units is given here first. Then the direct cost will here it will increase by 8% is given. Then the total direct cost. Then specific fixed cost will increase by 5%. Then comes capital allowances. So capital allowances straight line basis 25% on. So you can just take 25%. Right? In short, if you want to be sure whether the tax allowed, because I told you addition of tax allowable depreciation would be applied to your investment in non-current asset, or your in this case it is on plant and machinery. So plant and machinery was how much? 3 million. From this you have to deduct 0.4. Why? Because you are receiving, you are recovering. Maybe that was a residual value, because this case study is not there with me. Let me go and see. Yes, so it is 3 million. Right, so yes, so the value attributed to plant and machinery after 4 years is this much. It will be sold at this much. That's why from that you have to deduct. No taxable appreciation is available on premises. It's only for plant and machinery. So here when you take first, you deduct that how much you are selling it for, 400 from 3 million. That's why out of this, taking 25% straight line basis, is your taxable depreciation. So 0.163. Let me see. Yes. 0.163, 0.163. Add all, it should be equal to 0.65. Not 3 million. It should be equal to this after you deduct 0.4. 25%, of course, 25% on that. (25% means 25% on this difference, 3 minus 0.4. And because capital allowance is 25% and this 25% is for the tax. Tax is 25%, right? So don't get confused with this 25, that 25. Working capital. Working capital sales revenue is this much. 15% of increase in sales revenue. First here it will be 0 in the account, so just take 15% of the sales. Second year when you have to increase, make sure. Second year is this much. If you are taking 15% on this, but already 0. This is there, so this increase amount will go here. Increase amount only you are taking. How much from here to here? Here to here. Then comes to discount factor. You need to find out the discount factor. So looking at it, it's quite big enough. Looks like, okay, try to finish it out. So discount factor since cost of equity, so you have to use ungeared cost of equity formula, which is Mutkin and Minda's theory, this one, right? You have to find VD, you have to find VE. Once you find out, cost of geared will be given to you. Ungeared is 10%, just now you found out, right? So here also you are using your judgment. Just see, it's very close, 37.95, 37.952. So we assume the ratio is 1. That's why it's multiplication, right? So 10%. You are using 10% to discount that. Now the financing side effect. This is very important. From here your adjusted present value calculation starts. Till here you are able to do it. So issue cost has been given as 4%, right? That means whenever this is fixed, okay? So memorize it. 1 minus 4. Always when you have to divide it, the cost, it will be 1 minus the issue cost. 1 minus 4% is 96%. So this divided by 96% is this, right? Now you will be given some subsidized loan and all. You have to find that benefit. Maybe subsidized the loan will always be less than the rate which you are paying. So it is 2% here, and 80% of the project is financed that much. So this is the cash flow in year 0. What is the cash flow? 14.488. This also you have to get after you do your calculation. This one from here only. So your issue cost depends on that, and your subsidy loan. How much you have to finance? Of course, that much only you need to finance the initial investment. 2%. And 1 minus the tax rate. So 4% on this issue cost. This tax shield on debt working 6. There's a separate working for that. You have to add it. Subsidy benefit, add it. Working is here, right? Initial investment, out of that 80% you're financing. This is the subsidy benefit after tax, because 25% is tax, and then annuity factor you're taking if it's for 4 years. So you're getting this much. Finally the net benefit, and finally your net present value, base case net present value, you have to add with this, and the result is your adjusted net present value, right? And then you have to write this sentence whether you are going to take it or not. Now we'll go for the working and see the tax shield, right? So tax shield, they will give you that the ratings reduced, basis point reduced, so they can borrow at 300 basis point above the 5 year. 5 year is 4.5. 300 basis point above means 3%. It is not 0.3%. Most of you might have added 0.3%. It's 3%. That's why it is 7.5%. They can offer subsidies up to 80% of the fund. So from here, at a rate of 200 basis point below the borrowing rate, which is 5.5, because usually they can borrow at what, 7.5%, but because of subsidized loan, 200 basis point below, that means 2% less, 5.5%. So now the annual tax relief, you should know how to find annual tax relief for subsidized loan. One is the benefit of subsidized, the other one is tax relief. Two things are there. Separately you have to find out as a working. Here if you see here, what is subsidy benefit? One is subsidy, it's not able to write. So one is subsidy benefit, second is tax shield on debt on the subsidy, and third is your issue cost. These three things. Not able to write here. It's not able, I'm not able to write. So those three things for adjusted present value, which you have to know. Not able to